Hi everyone, how are you? Sorry for a slight delay in getting started, but that's because I've been putting up the latest, greatest slide. So let's get on to that straight away and show you what I've got on the screen. You're going to need your phone cameras for this because there's quite a lot of information and data that I'm going to share with you, including some great URLs. And for that reason, you will need your phone camera. Let me know you can see and hear me loud and clear. On top of that, I'm going to be asking some wonderful questions to you all. Let me know where you're from as well. And also let me know if this is your first time on here so that I can accordingly level it in the right way. Okay, so that's what it is. Second thing, please don't copy my slides. It's also not individual financial advice. That's what that says. Okay. That book hasn't been published yet. So one thing I'm not good at forecasting is my publishing deadlines. But yes, the point with this is it is not individual financial advice because I don't know who you are individually on here. So good evening, everyone. We've got Bedford. We've got Auckland, New Zealand represented. Zurich, fantastic. You will win. Wait a minute. You're playing Scotland. I'm going to go with a United Kingdom team on this one. Sorry. Switzerland, you just got to be neutral. What do you mean you're going to win? You got to be neutral. You're Swiss. Good luck though. Now, what are we going to do? We're going to cover the whole update. Please make sure you got your phone ready because, like I said, there's going to be such a lot of information covered. You're going to need it. I'm going to also share with you a copy of my book for you to download as well on this. So just so much to give you. Now it's the Juneteenth. It's somebody sent me this in earlier today. Thank you. I think it was somebody called Peter. Peter, thank you for sending this in. Forgive me if I've got your name wrong. Just in case people didn't know why the Americans are on holiday today, this explains it all. You can see quite clearly why they are. And it's the first federal holiday since Martin Luther King Jr. Day was instituted in 1983. There is a relevance to the stock market other than it being closed. Why I mentioned this. One of the things I like to do when I'm picking stocks is to look at, and I'm going to show you in just a second. There we go. I'm going to show you. I've got to click a button to make it happen. That I think data is more important than narrative. Okay. When I look at data, I get a better idea of what a company's doing. In other words, I want to see action, not words. The problem with words and narratives is this. In the US Constitution, it says all men are created equal. But from that narrative, a group of people got the idea that slavery is constitutional, right? So to me, it's almost as if, well, bloody hell, words are just absolutely useless. Actions or data is what matters. So I want to see what the companies are doing, and that's why I focus very much on data. So there is a relevance to June 19th to the stock market other than it being a stock market holiday. So as you will see later on, when I show you all of this data, the reason this data is important to me more than just narrative is also one of the things that Warren Buffett says, which is, well, I don't care what companies say because what are they ever going to say other than that they're amazing? I want to see their action. I want to see their performance instead. Now, one of the things we want to do, and I want to give some context to today, one of the most important things is, well, how long does it take to double your money? Well, statistically, if you generate at, say, 15% per annum, it takes 5 years, okay? Let me draw that on screen for you all. I just do want to make sure you can all... Oh, Trinidad and Tobago, Rene. Wonderful that you are from such a gorgeous place. I haven't been, but I have seen the pictures. Okay, so I've done one poll. Most of you think the FTSE will be higher by the end of the year. Let's do a one about the Dow. Now, remember, the Dow is not the S&P or the NASDAQ, so I'm going to do that poll as well. Okay. And see what happens if we do that. So I'm going to keep results on. Now, the reason I want to show you this about the 15% thing is if you get 15, then it's 5 years. Of course, if you manage to get 20%, it's slightly over 3.5 years. But just put 15 in your mind for a second. The S&P 500 ended up 28% from just October 27th. From just October 27th. There are periods when you are well on track to get those 15%. Not least because the 10-year annual return for the S&P 500 is 15%. That's just the index. Forget me. Forget trying to cherry pick good stocks. That's just the index. Okay, thanks, Alpesh. Thanks for that. I'll just get the index tracker. See ya, toodle pip. That's just the index. In sterling, okay, 15% per annum. If you were just using US dollars, it was 12%. Right? Well, shoving an Apple and Nvidia in there and you'll soon get your target. So I just thought I'd share that with you. That's from JP Morgan Asset Management, who manage money for extremely rich people. You can see the super rich don't like the returns you and I are supposed to be comfortable with, which is what your bank manager, your IFA, your wealth manager, your St. James's Place wants to give you, which is slightly better than a bank interest rate. These guys want to be doubling their money and quickly. Okay. So just thought I'd give a bit of an insight there. By the way, I've got an event. If you want to meet me, it's at the House of Lords Peers Dining Room. It's a free event. Lord Lumbar is the host. I am chairman of the Lumbar Trust, which looks after widows and orphans. It's an event I am moderating in association with the Royal Air Force. And this is why you'll need your phone, because you'll need to write that down. RSVP by 1st of July to cecil.soanes@abplgroup.com. Now, I suspect several of you who want to attend will be now fumbling around like mental, going, bloody hell, he told me to get the phone. I didn't. So it's there for a bit longer. Please do, if you want. It's a completely free event. We've got drinks, canapes, networking afterwards. There'll be a panel discussion as well. The theme is climate change. And as I say, it's in conjunction with the Royal Air Force. They're going to talk about how they have green fighter jets. Actually, they're amazing, the Air Force. You think all that flying around, they must be polluting the air. Funnily enough, not. So we're going to talk about that. And then we will retire to from the dining room to one of the ancillary rooms, and we will have drinks, canapé, and networking. So I do hope you can all make it. Okay, so there's the invite, 12th of July. You can see there, and you RSVP there. I have to point these things out because I've realized with these things that people miss things. Now, one of the things we're going to talk about in this webinar, as well as the stocks, the stock market update, everything else, one of the very important things I want to talk about is these three types of falls in the market. When the market's rising, you don't need me, you don't need anybody's help. But when it falls, you need to be able to distinguish three types. This is called the daddy bear. You want to be in cash, 2022. This is mama bear. You might sell some of your position if you're risk averse, if you're risk loving, you won't need to do anything. And this one, baby bear, you don't need to do anything at all. You can ignore it. How do you tell the difference? The way you tell the difference is you look at the monthly MACD. If it is rising, it is a baby bear. If it is falling but not below its own moving average, it is a mama bear. If it's fallen below its own moving average from a height and cross below, it is a daddy bear. Okay, very simple. Now you can do that with stocks as well. It's not guaranteed to work, but it's a hell of a lot better than all the ways in which private investors mess things up. When they don't have this approach, they either stay in too long in a stock or they get out too early. This pretty much helps them resolve 80% to 90% of their decision making on exiting. Got it? Simple. Now, we'll come back to some of that a little bit later on when I look through individual stocks in just a moment as well. As I said, let me know. I get worried when people don't message me for a while. Please let me know you can indeed see and hear me. The last one was Renee. Now, what is this? Everything's overvalued that's in red. It means you're paying $33 for every expected dollar of profit in Microsoft. Okay? You're paying $33. So why would you buy an expensive company? Well, how come expensive companies are the ones rising? Well, for several reasons. Value is not the only thing that causes prices to move. And secondly, measuring valuation based on that metric is one of several ways of measuring valuation, not the only one, such as revenue growth is important. So price to revenue growth could be important. Price to profit growth, PEG ratio, could be important. The ones which anyway on this traditional old-fashioned metric are cheap are the ones in green, and we'll keep an eye on some of those, right? But I show this for a very instructive lesson that you'll get all these people screaming blue mode, oh, the market's really expensive, isn't it? Okay, because I don't know, they've come straight off watching children's programs and they you know, their IQ's got a bit stuck. They foolishly think that there's only one measure of what makes stock prices move, and that the old-fashioned singular measure that they have is the correct one. Incredible. No wonder they lose money. Now, several things you need to know and watch out for in terms of earnings coming forward. I don't think any of these are market moving. I don't think these are market moving. I don't think these are. I mean, FedEx. I was in New York a couple of years ago and we were talking about the FedEx results, and somebody, one of the presenters on Bloomberg TV, Bloomberg, who was interviewing me, said, "Oh, results don't look good, or if they're not good, will it tank the market?" I said, "When the hell has FedEx ever tanked the market?" So same thing there. Micron, possibly, because it's a tech company, might be the most important one on Wednesday to look out for, but not critically important. So it's going to be a pretty quiet week, is what I'm saying. And where are we on sectors and earnings? That's the 0% mark. You can see some sectors, and I don't do top down, i.e. sector picking, I do stock picking, bottom up. But you can see some sectors are almost all of their picks, almost all of their stocks are up, like utilities. It's like almost a no-brainer. Whereas others, you better stay clear, like real estate. Okay. Hi, Trevor. Okay, Chris, Eli Lilly, I'm going to come to as well. And you can see in technology. Now, here's a warning about sectors. Now, financials, by the way, looking good, and communication services. But here's a warning. Communication services, Alphabet, Netflix, I thought they're tech companies. No, apparently they're communication services. Alphabet is not like, apparently, Apple or Microsoft. Who knew? So I don't like these sector labels because they're not actually very instructive usually. Okay, so be careful. I like to look at the companies themselves, and then what I call what is known as bottom-up investing. You look at the companies, you don't care what sectors they're in, you don't care what they do. You need all of these first 5 things to be green. I'll explain why in a second. Okay, well, I've shown a chart here. First 5 columns need to be green. I'll explain why. Not least because we want companies to be undervalued, want them to have good profit and sales growth, and we want dividend yields. We know valuation is more important than growth, which is more important than dividend yields. If you want to reverse engineer this valuation, you're really looking, we've looked at the research based on work of academics and on brokers and analysts and the research that they've come up with. And we found that valuation, you can actually use an absolute measure of valuation. It's not the only one, but such as a PE between, say, 2 and 20. And you might say, wait a minute, won't that exclude all the loss-making companies or the tech companies? Yeah, but then growth will make up for that scoring. And we score out of 10. Valuation gets a weighting of about 50%, growth about 25%. Dividend yields about half of that, and then the rest is filled up with cash flows and so on. Okay, so that needs to be, and growth is revenue and profit growth year on year. Dividend yields, pretty much anything that's positive will do. And that's a rough and ready, pretty like a dirty martini. It'll do the job, okay? Cash return on capital invested from Goldman Sachs Wealth Management needs to be green because that gives 30% per annum. In general for companies which are green, i.e. companies in the top quartile. And I'll come to these 2 factors in a second, Sortino and Alpha. They're sort of our way of cheating by using hedge fund metrics to basically find a backdoor key into good companies, because what they do is they look at the average return, statistical return of a stock price, and its ability to outperform the market, whether the market's rising or falling, and very little downside volatility. If you think about it, those are the things you want. So whilst that doesn't guarantee, past performance doesn't guarantee the future, it is statisticians will tell you it's a pretty bloody good guide, but it's not a guarantee. There's a difference between a 100% guarantee and a 70% guide. Okay, past week, this is how it's looked. Well, it's all those overvalued companies. Stay away from those, Alpesh. They're at all time high. They're too good. No, stay away. Well, actually, they've been doing well. We'll have a look at Tesla because we've been out of it since October. Is it worth examining? Okay, you can see Eli Lilly. Healthcare sort of moved down here. I guess the boxes have rejigged themselves. Okay, so we're going to have a look at some of these and see if are there any opportunities, and how do the ones that we already hold look as well. ETFs, not really to be covered in this webinar. I do have a bunch of leverage ones, which, because they're leveraged, because I'm willing to take higher risk, I'm more than happy doing. So that's all well and good with those. As well, by the way, will the Dow end up 2024 from today's levels? Will it be up? 45% said yes. 36% said no. So I'm going to reset that poll. Now, I've got a theory. I'm going to do a poll. I'm going to see if I can do a new poll. Okay, so while I speak to you, this is markets year to date. The NASDAQ is up a whopping, what is it, 18%? Will you're gonna see this poll in a second, right? And I'm gonna see what you all think, because I think the answer is going to be a shocking yes. Okay, so let's see. Publish. Now, I've just published a poll. See what you think. Will Farage be PM in 2029? Is he going to do a Trump, what Trump did in the US? That's amazing, isn't it? And there's your 15%. We're only halfway through the year, and S&P's already got double your money in 5 years. Return already. Boom. Thank you very much. These are the sectors which did well. Now, you will know I don't gamble on sectors. That's January. I don't gamble which horses are going to win. What I do is I look at solid companies. If they happen to be in energy or technology or communications or financials or utilities, so be it. I don't say I'm not going to have any real estate. Equally, I don't say that's a lagging sector. Let me write a story about how it's going to do better. This is some of the tricks that these bored financial journalists use when, as I say, they're bored. They say, oh, let me write about real estate because that's my patch. And the danger with that is they can only write about their patch and they don't see the whole picture. My job is to see the whole picture. Okay. What about this year to date? Again, these styles, momentum, value, growth. You want to make sure you've got a company which hits growth and is undervalued and has momentum. So it's in that sweet spot and a bunch of other things. Do you see what I mean? You don't ever want a fund manager or an IFA who says, oh, well, we've got a growth fund, we've got a value fund. If we mix them together, you'll have a great portfolio. It doesn't work like that. If you have a load of rubbish here and a load of rubbish there, mixing it together doesn't make it quality. Okay, it just doesn't work like that. You need to make sure that the companies are undervalued and high growth as well at the same time, and producing income, etc. So you're not gambling on this sector or this. Somebody sent me an email today and said, oh God, I just realized that with the volume, the amount of money I've got, I have really been playing, he didn't use these words, but been playing it like a cowboy. Basically didn't realize that he hadn't been doing enough due diligence, been sort of just, somebody said this, and I heard somebody on TikTok say that, and I heard somebody in a magazine say this, so I should just randomly pick these companies. No, it's your money, it's your pension, it's your life, it's your children's future inheritance. You need a diligent approach, a sophisticated approach. Okay, so you need to make sure, as I'll show you in this webinar, you tick the value, growth, income boxes. Market so far over the past year, from June to June, 32% on the Nasdaq. How's that? S&P 24%, well above the double your money in 5 years. Okay, run rate that you need. The Dow 13, that's closer to target of 15% per annum to double your money in 5 years. I'm looking to double it in 3, because with my, I'll see all those books over my shoulder, with my experience, expertise, and knowledge, and all my data, I should be looking to do a bit better, shouldn't I? Okay. Now, here's something interesting I want to show you. This is really important. Notice how market, you go up, you're delighted. Then you're despondent because it fell and you lost all the money you thought you made. Then you're delighted again. Then it falls back and then it goes up. The point is, markets go like this. They do not go like that. All right. So if you start here, you're going to be mighty worried by the time it falls here. If you start here, you're still going to be mighty worried because all your gains went. You are going to go through that period of worry before you go from here to here. All right. You're just going to have to go through it. And therefore, one of the most important, insightful things you can do, which I'm going to teach you, is look at those historic drawdowns in any security you own and make sure you're comfortable with it. Otherwise, don't buy that security. And the duration to go back to break even. So peak to trough, drawdowns and depths. Depth of drawdown and duration. And we'll come to that and I'll show you specifics in a second. That one thing will remove a whole load of things you don't want to do and have in your portfolio. Okay, it'll remove the roller coaster rides. And as I said, the other thing, working out whether and whenever it's a baby mama or daddy bear market. These are the top rises over the past month. Hargreaves, of course, has got that bid going on as well over the past month. These are the ones over there. Can't believe they're up now that they've dropped out of the FTSE 100. That's bottom fishing, if anything. Okay. What do they call it? Dead cat drop. If you drop a dead cat, or actually, if you drop a cat and it dies, it bounces. I mean, I don't know. Guys in the market, they're sick. they come up with these terms. So I guess it was having a dead cat drop. S&P 500, well, it's rising, and that seems to be rising. So I'm pretty happy in this benign environment. I think until we get more earnings results, we should be doing quite well. And any drops we get will be baby bears like that. How's that a baby bear? Because the monthly MACD was rising when the price was falling. We might get some mamas, over summer, but that's not even a mama actually. Because look, actually no, that was a mama because the monthly was falling, but didn't cross its own moving average. Okay, so things look positive to be buying stuff. And here's something else. Look at this. Get excited. See that 9 years. For the last 9 years, every single July, the S&P 500's gone up. So I had a little phrase, buy in July and it won't go awry. It's my alternative to sell in May and go away. Now, NASDAQ 100. Oh, by the way, so I've got my S&P 500 tracker and I've got my triple leverage S&P 500 ETF. I've also got NASDAQ and triple leverage NASDAQ as well. And why? Well, there. And I'll continue having it until we get a daddy bear. When we get a daddy bear, I might get rid of my NASDAQ triple leverage and my NASDAQ tracker. But my son's got it in his ISA as well. And similarly with the S&P 500. The triple leverage will go when we get a daddy bear. Until then, we're going to keep hold of it. And we're more than happy to do that. FTSE 100, well, it's the monthly MACD is rising. So this is just a baby bear. You can ignore it for now, unless it becomes a mama bear. But like I said, my biggest worry with the FTSE is always it sort of makes this leap up and then leap up, then bit like a vegetarian on a run. It's like, strong start, but just no finish. S&P 500, top 10 S&P 500 stocks over the past month. Can you believe it? Over the past month alone, the bloody thing's up. The world's most valuable company, the most valued company, NVIDIA. So where are we? Will Farage be PM in 2029? And that's what we've got. I'm going to keep a screenshot of that because I think I've got to share that. Okay, I think I'm going to share that with a bunch of people on LinkedIn. This is absolutely bloody insane, but he's going to love it. I'm sure that's a pretty close tie. I mean, I think he'd take that. I suspect he's doing it because if you can't even get a Coots bank account, you need to do this kind of stuff, just like Trump did to make the money. I think he's doing it for financial reasons. Right. So those are them. We're going to cover all of these and see if any of them look interesting. Okay. So let's start off with NVIDIA. Now with NVIDIA, as you know, from when we got in January 2023, because it was ticking all our boxes on here, on the rebalance in April, on the mama bear, got out. And I should have only got out 50%. So I got back in the 50% I didn't sell. And why did I not keep hold of all of it? It was just too unbalanced. I mean, it was just too much money in just a few stocks because we'd held it since then. It had gone from, what is that, about 15 to 135. I mean, come on, we're talking nearly a tenfold increase in what my wife had. Sorry, not my son, I had on this. He had 2 times leverage on Apple, for instance. So given how much he had in just a few tech stocks, I did a rebalance in April. Now, for when to hold it? Well, if it dropped, oh God, I'm going to repeat what I've been saying during this period and this, excuse me, which is, such an interesting moment. And I go and have a sneeze. The point is this: if it drops X, sell Y. What's X? Well, it could be 10%, could be 15, could be 20. Sell Y. What's Y? That depends on your risk appetite. Really simple. First Solar, bit overbought. So whilst it's had this massive run up and its value growth income 7, no, not for me. And I know these other places like it, but were you to buy it, contrary to my admonitions, you would remember that historically its drawdown depths are pretty steep and durations are pretty steep as well. Broadcom has just been on a rip for so long, on an upward trend. Look at this. It can drop 40%. So make sure that if you're going to get in, and we think it's overbought, so it's not for us, even though on a growth value income, it's fine. So it's not one for us at the moment. And it has been in the past. AI picked this in May. If you're on my Telegram, you'll know it picked it in May, and I showed what had happened from May till now. So it got in at 569, and it's pretty much tripled since May of last year. So we do a little AI exercise, and that's what had happened there. Now, here's what's interesting about this one. Again, if you, contrary to our rules, because it's overbought, get in, then if it drops X, sell Y. But make sure you're appreciative of the fact that this can drop 40%. Okay, that's its drawdown depth. So don't get into a stock and then go, oh, Alpesh, it's dropped 40%. And I'll say, well, yeah, that's what it does. That's its characteristic. That's its nature. Okay, they're not all like that. Best Buy was one of the big movers that you just saw in the S&P. Okay, but not for us, because whilst that is attractive, and whilst UBS have just announced on the 17th of June that they want to buy it, it doesn't hit our value growth income requirements, so not for me. Micron is one, as you'll know, we've had since last year. It is overbought. We will sell only if it drops X, I'll sell Y. What is X and Y? Well, I'll make a decision, knowing full well I'll just wait until it happens and I need to make a decision. I try and avoid making decisions until I need to make decisions. I try not to hypothecate well in advance of, well, what if this? What if that? What if this? And on a Tuesday and it's raining, what then? And whilst I see that, I don't care what the analysts think. Would I buy it today? No, because it's overbought. But are we continuing to hold it? Yes, because we tend to hold unless if they drop X, we sell Y. CVS has been pretty rubbish, actually. Well, rubbish as in it dropped. However, it's in line with what it's done in the past. Now, what if you wanted to risk mitigate some of these, Alpesh? These are things you can do. First of all, never buy it. If you want to risk mitigate, and I'm fine with taking this risk, but you might not want to, then never buy anything where the MACD has not crossed above its moving average. Just don't do it. Okay? It'll make life easier for you. I don't have a problem with that if it hasn't, but other people, if they want to mitigate their risk, they can do that. The second thing is just look at previous drawdowns and say, well, I don't like, and work out what your numbers are. Your peak to trough drawdown, if you're risk averse, might be as little as 15%. Well, don't buy any stocks where the peak to trough drawdown has been 15% in the past on an upward trend. Don't do it. Equally, if it is 25%, then don't be surprised when that happens. If it is 31 or 32% as it is here, then don't be surprised when it happens. Okay? And say, well, that's fine. That's happened before and it'll happen again. And it's bounced back since, and look what might happen. Ooh, oh, okay, so no need for tears. Hewlett-Packard, whilst it's a 9, it's overbought, so it's not one for me, and you can see the drawdown depth in the past. Now, why am I drawing those to your attention? I'm drawing those to your attention because sometimes people assume that whatever's happened in the past is irrelevant and that the future will just be a smooth straight line. No, the past is a pretty good guide as well. Okay. Thank you. Lamb Research. Now, we've had this in the past and we've loved it in the past. And it is one of the ones which I didn't buy this time around when it was on our list a few months ago. But I know some of you did, so it's still a continue to hold. I wouldn't buy it today because it's overbought and not on our value growth income. However, if you own it, you would exit when, if it drops X, you would sell Y. Okay. And it's a good one to keep an eye on for the future as well, but be warned, look what happens in its upward trends. 42% can happen. So you might say, bugger that, mate. Oh yeah, I like the gains, but I don't like the drops. Determine it on the drops, not the greed of the gains. Okay. And by the way, if you want to look at that and think, well, would I have missed NVIDIA? You don't count the downtrends, which are easy because that's when the MACD is falling below the moving average. We're talking about uptrends like this. If you look at it, its drawdowns were pretty low. I mean, even in COVID, they weren't that great. So you wouldn't have missed it on that. So just look at historic drawdowns, and if they're above your number, and work out what your number is. Is it 15? Is it 25? Okay, don't make it 50%. That'd be awful because that's just taking crazy risk. HP doesn't meet value growth income, even though that looks okay-ish. But look at that. Oh, 37%, not for me. I should blacklist anything which has a drop from peak to trough on an previous upward move of more than, I don't know, 25%. Should just blacklist it. Qualcomm is one I continue holding. It's one that I've not talked about for a while, even though it's been doing great. They were like, we'll continue holding it because that keeps going up, and unless it drops X, I won't sell Y. But I will be mindful 31% is the kind of drops it can have, and look at these volatilities. So it's done rather well going up in a straight line, but let's not make the assumption that will always happen. How's Oracle? Overbought. Yes, value growth income is good. but it's overbought. So not one for me at the moment, but it's one we'll keep an eye on for the future to give us some great gains. I mean, look at the gains it can give you, from 50 to 100, doubles your money, this company. As so many American companies so often do. Costco, it's been good for us in the past. It's not one I don't think I've got at the moment. But we've had it in the past, overbought, and value growth income doesn't hit. Doesn't mean it's going to fall. It just means it doesn't meet our criteria. So we've got other companies which will be better fit for us. It is a good company. I do like it. I, in fact, pretty much love it because its drawdown tends to be in an upward trend. That's not an upward trend. That's a downward. How do you know? Well, you just look at that. Okay, in an upward trend tends to be quite shallow, only 19%. Love it, love it, love it. Apple. Well, if you're on my Great Investments program, you know my views and what I've done with that and with Amazon. Those are the charts for anybody to look at. But and some of them with Microsoft, you know what I've done. You know what my son's done and my wife's done on those, and with Meta as well, which, as you know, I exited back in April to rebalance and wouldn't buy more at the moment because even though value growth income's there, it's a bit overbought, and I needed to rebalance since January 2023, since when it had gone crazy up. Okay, I'm going to got more stocks for you. Don't forget, on YouTube, you've got a whole bunch of videos like these ones why IFAs should be locked up. Bank of America was one of the good performers. Again, not for me because it's not got value growth income there, even though it's been going up. So there'll be companies we just don't have because they don't tick enough of our boxes. And you might say, you're a fool. We're not trying to create a perfect academic record. Okay, that's not our goal. Netflix is not one I bought, as you know, but since this period, since here, I've been covering it and it's gone there. And you might say, well, don't you regret it? Yeah, so what? We didn't buy it because we can't buy everything. And this just keeps rising. It's now at the levels it's been before. And the worry would be something happens. I'm not saying that's going to happen. I'm just saying it doesn't meet our criteria because it's overbought. Do you see how comfortable I am of not buying companies? Just like Warren Buffett, just really comfortable not buying them. Walmart, whilst it meets value growth income, is overbought, but look how smoothly that is. What I don't also like about this is it just has long periods of bloody doing nothing. Tesla, not yet for us. It won't be a special situation yet for us. It did as well from January to October of last year, but at the moment, the MACD is falling. We never buy into anything where the MACD is falling. Okay, Berkshire Hathaway doesn't meet value growth income. So the great man, sorry, and that's overbought. Not for us. Eli Lilly's been doing wonderfully well, of course, and it does tend to have shallow dips. 21% is probably as good as it gets. I think Microsoft is slightly less than that, and they're probably the two least shallow companies that there are. But that's a bit overbought. Now, you might say, well, wait a minute. I just want to do like with NVIDIA. I don't care it's overbought. I'm just going to trade it on momentum. I don't care about value or growth or anything else. Fine. In which case, just make sure that if it drops X, like 25% more than what it does generally, you will then make a decision to exit. Don't make it if it drops 10% because you know it can drop 21% and still climb up. Okay? So you can work it out yourself based on your risk appetite. I know all these people absolutely love it. Walt Disney, that's fall is a baby bear. Why is it a baby bear? Well, because the monthly MACD is rising. It's not falling. So it's a baby bear, so you ignore it. Don't forget, you've got all of this as well. So that's the update on the markets. I'm pretty happy. I'm happy with all the positions that I've got. Follow me on LinkedIn. I've got a bit more stuff for you. And this is for the people really who haven't understood why their portfolios are underperforming. Well, active fund managers for very long periods of time underperform. And that's what I want to talk to you about now. And it's well known. So you get companies like St. James's Place kicked out of the FTSE 100 because they're selling you fund managers who are rubbish and people are catching on. Customers of St. James's Place paid most with £583 million in investment funds whose performance the firm itself has concerns about. So they're picking bad funds, and there's been numerous investigations into how they're rubbish. Quarter of your pension has gone in 1 year if you've gone into, say, Blue Whale. These are pension funds. These are managers who are supposed to manage your pension. You might think, surely I can't lose a quarter of my pension. Well, time and time it happens. So let's talk about some of the mistakes that people make and how you might be able to avoid them. Well, first of all, they don't look at all the relevant information. You really need in your due diligence to check valuation. Now, it might just be a P ratio, which is how much you're paying for every pound or dollar in profits. You do want sales, i.e. revenue growth year on year, and profit growth, at least for the last 12 months. And you do want positive dividends. If they don't have it, it's fine, as long as the other two things make up for it. Okay, it swings and roundabouts, and valuation is the most important. Growth, half as important as that. Income, half as important as that. Now, momentum, I've talked about a lot, so I'm not going to mention it. And statistics, you really want the Sortino and the alpha to be pretty as high as possible, but positive. Those are the ones which say average return is high, downside risk of missing it is low. That's Sortino. Alpha is market goes up, you go up more. Okay, so you want that, and you want volatility under 20% usually. More volatility or risk does not mean more return, contrary to what people think. Okay, and the people who think that, more risk, I'll get more return, are fundamentally just messed up. I mean, it's just not the case, because I can give you enough examples to prove to you more volatility does not mean more return. Okay, now, not knowing when to hold and when to sell, that's another problem. So like I said, you hold during a baby bear, you probably will hold most of it during a mama bear, and you exit in a daddy bear. I tend to hold for 12 months, then redo the exercise of this, unless the stock has fallen 25% from its high since I bought it. 25% or 30 or 35 based on how much it historically has fallen in the past. Okay, simple, really simple. 12 months or drop. That's it. Okay, and if I get worried, I just say to myself, I look, is it a mama bear, baby bear, or daddy bear? Oh, look, it's usually just a baby bear or a mama bear, so I can ignore those drops. Very comfortable. The other mistakes people make, polarity through analysis. They just take tons of analysis and they get paralyzed. The other thing is, mistake number 3 I want you to avoid is they don't understand it's the big winners that make up for the losers, and it takes 12 months. Markets will often go like this. This is the pattern of a typical year when a stock makes 50% return. First goes off great, then drops all the way back down, then goes up. Here's another pattern of a stock when it makes 50% in a year. Drops, you're underwater, and then goes up. Those two patterns are consistent with a 50% winner. Yet people say, it's been 3 months, where's my return? Okay, it's not like a run rate. And like I said, you will get years. A year in which you might get a tailwind like 2021, and there's been quite a few tailwinds recently. We want to be in a position when there's a tailwind to take advantage of that and do incredibly well. So if you take a year like this, where there's a tailwind, 2021, 2023 as well, and you take advantage of that opportunity, that 54% will be composed of some stocks which went up 208% or 137%. That means some of them went up a lot less than 54. They went up, or maybe they were even negative and got stopped out. That's how it is. It's like a barbell. Some extremely high earnings, you never got rid of those in the 12 months, and some hit a stop loss. Well, you cut those losses because you had the 25% rule. Okay? It isn't that every single stock, because of the process being the same, makes the same amount of money. It just isn't. And people often don't understand that. Okay. Equally, what they do is they say, I'll take lots of risk because hopefully I'll get some of these and that'll make up for some of the poorer ones. It's just random stuff they've come up with and they made up themselves without testing any hypothesis. Exit plan. Right? 12 months, reevaluate, drops 25% from the high. Or as I said, if it's not 25, it might be 30, 35, depending on what the historic drops is. But I really don't want stocks which have dropped more than 40% historically in an upward trend, because it's just more volatility than I need. You might say, but what about Nvidia? What about Apple, Amazon? No, they haven't done that. Okay, what about Meta? Yeah, it did that in 2022 when all the stocks went down and we were in cash anyway. So why were we in cash? Because it was a daddy bear. What's a daddy bear? MACD falls below its moving average. Simple. They look at too few stocks, so they end up with rubbish. If you're looking in a pile of rubbish, you're going to find rubbish. He's an IFA turned fund manager at St. James's Place, and this is his side gig to make ends meet, and he is looking for a stock pick in there. Okay, and that's the problem. Or you pay more to fund managers than you realize. Now, let's go back to picking stocks, too few stocks. There's a UK fund. It's only going to pick UK companies. Are you crazy? There's 10,000 great companies on the UK and US exchanges and European exchanges that are listed in the UK that you could buy, and global companies that are listed in New York that you could buy 10,000 in total, and you're only going to pick some UK ones, or even worse, UK growth. So you're going to pick from a narrow gene pool. No wonder you're picking from such a small number that you're bound to underperform. That's why fund managers underperform. The other reason they underperform is in years like 2022, when the market drops 25%, they can't go into cash. Do you hear what I said? They can't go into cash. They will sink you. The IFA will not say to you, get out of my asset class, stop paying me. What they'll say is, yeah, well, let's look at more funds. Yeah, Jeremy Huntington Smythe is awfully clever. He went to the right school, fee paying, of course, and went to the right university. So you should trust him. I've been to those right schools and those universities and have more qualifications than those fund managers. And I'll tell you something, it is not going to make you a better fund manager because they're handcuffed to not being able to exit when the markets fall. So they're bound to fail. That's why they're so easy for me to do videos about on social media and say, that one's a rubbish fund, that one's a rubbish fund, because I just need to look at 2022. They couldn't go into cash. So they're going to lose you 6 years of your pension, as Scottish Mortgage Investment Trust did when it dropped 50% in a year. And Blue Whale dropped 27% in a year. So I just give it enough time and I know they're going to lose 6 years of your pension. For 6 years you go up, so what? If you lose it all in the 7th year, you're screwed anyway. You're back to where you were, snakes and ladders. 10% to be kicked in the teeth. This is from an actual fund manager. One of my clients sent me this, that their fund manager had sent them £10,000 cash in after 5 years. You're going to pay 10% in fees. Jeremy, yes, that's correct. Good evening, Alpesh. Thanks a lot. Thank you. Confident now. Do you plan to do monthly subscriptions? We do installments, so we do monthly, but it's not a subscription as such. It's because you're only paying one off. So it's just a one-off payment you're paying, if you see what I mean. But it's divided into installments. Subscriptions would mean charging you forever, which would not be good because there'd be a conflict of interest. Then I'd have the interest of saying to you when the market's falling, don't go into cash, because you'd say, well, what am I paying a subscription for? Because you're telling me to keep buying stuff. Okay? Because I'd have a conflict if I charge you a subscription. From a typical fund, £10,000, average return each year, average return. This is from a fund manager. They're trying to get you that I get 4.9% in my bank account, instant access. So why the hell would I want 5% with a fund manager? You might say, well, it was 0.2% more, Alpesh. Yeah, I can do the maths, but it's got risk attached to it with a fund manager. This is a typical email. Now, you might be able to relate to this. I've highlighted in yellow, my own pension provided by Legal & General. This was provided by my employer. Please check your employer pensions. The information was shocking 20% growth between 2012 and 2022. Been following your weekly report, and I've invested very little in some, but I've seen returns around 20% this year. The fund managers will shove you into funds in which they get fees, and those funds will spray and pray into 50 to 100 companies. And you might say, well, that's good. Well, why don't you see what financial news has been telling you for probably a decade? There's only a few companies which generate the returns. So what's the freaking point of putting it into 50 to 100 companies? They don't generate the returns. And you might say, well, if it's so obvious, why don't they do it? Well, Warren Buffett does it right. He does it right. Bill Gates does it right. Okay, he's another one who does it right. The billionaires do it right, but then they've got access to the data and they're not going to give their money to Hargreaves Lansdown and St. James's Place. So what kind of returns might be realistic? Well, 40% isn't realistic. And I'll tell you why. You would need a market in a year. You'd need a market tailwind like 2021, 2023. Thankfully, we've had a few of those. You need high Sortino. That's high average return versus downside risk and high alpha stocks. Not emerging markets, because you'd have so many landmines in buying Vietnamese stocks. You're going to blow yourself up and lose at them. Okay, not UK. It's just too small. It's tiny. It's a tiny little island. Okay, it might be the Europe's largest exchange. I'm afraid 10,000 stocks to choose from, US. And I wrote that in my first Financial Times column in 1999. Thankfully, your SIP and ISA can invest in foreign companies because your government wants you to have a good retirement, believe it or not, and they don't want you to be a burden on the state. Really, they don't want you to be a burden on the state. They don't really care about how good your retirement is. If you can go to cash in bad years like 2022, that's going to be critically important. If you monitor once a fortnight, well, because if something drops, you'll want to get rid of it. You want to prune things. If good years make up for bad, thankfully, there's usually 5 good years out of 7 and 2 bad ones like 2022 where you're holding cash. Croaky, cash return on capital invested. If you hold for 12 months, then reevaluate. If you sell anything which drops 25%, the rule, the exit rule, you got to, is that effort worth it? Is it worth it? Okay, well, let me give you the grand reveal of what happened to us last year. Last year was not typical. Last year was not typical. These were the ones we had for last year, which met our criteria of rising MACD, our quality 5, and our filtered list. Okay, these were the ones from January. I'm talking about January. I'm not talking about February to February, March to March. We're talking January to December. I'm not talking June to June, although you saw what the NASDAQ did. It probably be just as amazing. 80% is not typical. Of course, it's not bloody typical. Now, somebody said to me, yeah, but if you take out NVIDIA, you wouldn't have been so good. Yeah, no, you're right. If we take out NVIDIA, Meta, Amazon, Tesla, Sterling, ServiceNow, basically, if we take out all the companies except Tapestry, we would have been down 1.68%. Wait a minute. Why couldn't you just pick the big winners? I'm afraid it doesn't work like that for me or Warren Buffett. There's an X factor in the market, which means that there'll be some, like an NVIDIA, AI blows up, does incredibly well, even though it hit all our figures. And there'll be others like Aperion Networks, which also hit all our digits, which only does 22%. That happens. If it didn't, me and Warren Buffett would just buy one stock, whatever that stock is, because we'd know it's going to go up 238. Did I know they were going to do that last year? No, I did not. Okay, will it happen again? I don't know. I like what Jim Simons, the billionaire hedge fund manager who recently died, said, I have no opinions on any stocks. The computer has its opinions and we slavishly follow them. I love that. I didn't know he'd said that until he passed away recently. And what a genius he is. He only started investing at the age of 40 and he made more than $100 billion. Okay. Yeah, Stan, just get in touch with Paris. She'll give you all the results since 2004 when we started. So yeah, Parish@tradermind.com. Andrew, I don't think it would be necessary. Oops, wait a minute. I don't think you'd necessarily have a conflict of interest. A monthly rise to hold cash. I would, because only I know I can judge what I would believe if you were paying me a subscription. I would believe, oh shit, I better give them some stocks. I better not tell them to hold cash. And you might think, no, you would because it's in our best interest. No, I wouldn't. I'd say, oh shit. Oh no, let's just find a company. Got to find a company. It's human nature. Okay. This was 2023. Okay. And what we're looking at is undervalued companies which are growing with dividend deals. Now, tell me, what have we missed? Stan, what have we missed? Undervalued companies which are growing with dividend deals, good cash return on capital invested, that's the Goldman Sachs thing, high Sortino, high alpha. Tell me what I've missed. Tell me what isn't included in there, which is the essence of a good company. I'd like to know what I've missed. What's the data point you think we've missed? That'd be really good, because it'd be really good after 25 years of knowing, oh shit, we missed something really important, and these returns were just pure fluke. Might have been. We had a great tailwind. When we have a tailwind like 2023, we do incredibly well. When we have a headwind like 2022, we get barely above zero. Okay, might even fall if we didn't get a few energy stocks in 2022. Imagine we didn't get any energy stocks in 2022, and because Russia went into Ukraine. Okay, so we managed to get some energy stocks. There was a lot of worry and concern. So imagine we didn't get those. Then would be 0% return. Might even be -1, -2 if we didn't get the energy companies. -5. Okay, just so you know, that's what would happen. But I'd love to know what we've missed. Momentum does have its drawback. It's included in there. Okay. I'll send you Parish's email address. There you go. Hopefully you can all see it. I think that's why I assume you also look at value. I look at value as well. So there we go. Chris, what? And that increase excludes your... Yeah, I'm excluding leverage because that would be unfair to include leverage because that's personal to my my risk appetite and my son's risk appetite, or the risk appetite I put on my son. Okay, assume you plan to invest over 10 years. And let's say you make 20 because 15 is the S&P. So I can't say, let's say you make 12 because that'd be worse than the S&P, wouldn't it? And let's say you got 100K and you add a little bit into your portfolio each year, then you get $1 million over 10 years. That's what you're after. It doesn't ever look like that because what happens is it looks like this instead. Okay, that's how things look in real life. Probably what everyone's trying to get to is this period where there's a large, meaningful sum made in just a year. The reason they don't bother doing it is because in the first few years, you're saving, but there's not a meaningful return each year. Why isn't there a meaningful return? Because you've got less capital. It's just a multiplier compound effect. The reason why most people don't compound is because it takes time. It's deferred gratification. And most people, as we know, don't do deferred gratification. Okay. What this shows is why the fund manager IFA industry succeeds so much. Because what they're trying to tell you is, hey, Alpesh, give us more money, then you'll get a better pension. Hey, Alpesh, start earlier, i.e. give us more money sooner, because then you'll get a better pension. What they won't ever say to you is, tell you what, mate, don't screw yourself by starting at a young age, giving us all your money. Let us just do the hard work and get you a better performance. They won't ever bloody say that, because that's actually the thing which can move things and move the dial, right? What they'll always say to you, if it's crap, which it invariably is, hey, give us more money. Then it won't be. Well, hang on. That's like saying, if I give you more money, you'll give me more money. You're just giving me my own money back. You're not adding to it. I was talking to one of my students yesterday. We went for lunch, Ravi, and he was saying how his mother-in-law's IFA had basically all the money they'd put into the pension had gone to him effectively because he hadn't generated a bloody return. My belief is you can beat numpties like this. So with my big math in 2004, I took the test with Financial Times and we ran a competition, which I won, on who can perform best in terms of what's going to happen with the FTSE 100. And Neil Woodford was rubbish. We knew it was rubbish then, but the media wanted to keep, they love their celebrity fund managers. So they wanted to keep plugging. And if you've got profile, Hargreaves Lansdown will take you and distribute the crap out of you to a whole bunch of people via email who'll go, well, he must be good because the newspapers are experts. And they said he's good. And the journalist said he's good. So he must be good. And they're really good at marketing. And well, we knew it was rubbish because I don't care about the marketing narrative. I care about the results. I care about those numbers. And those numbers were bloody awful back then. Okay. You missed overall direction of the market, I guess. I don't understand what you mean. What's the overall direction of the market? No, MACD. That looks at the overall direction. I just showed you earlier on. It was a rising MACD. We don't get in if the MACD is falling. So we haven't missed the overall direction of the market. It was slide number 3 on the webinar where I said S&P, overall market, S&P. If it's right, the MACD is rising. So I'm really pleased. It was one of the first things I showed. Stan, stay away from the market. It's not for you. Open SIP and ISA. Really simple. You don't have to use Barclays. You use anybody you want. I'm not linked to Barclays or any of these. Take a picture of that, okay? Because that will. I mean, what the best way to do it is not necessarily any other. You call them up and you say to them, "I want to buy $10,000 worth of XYZ stock or £10,000 worth of this. What's your cost?" And call each one up because it's like plumbing tax returns. It's so complicated what they do. Beware of name recognition fund managers like Scottish Mortgage Investment Trust. That's 50% they lost because they didn't look at the overall direction of the market, Stan, when the MACD was falling, not just in the big name stocks, but the S&P, the NASDAQ, the monthly. And generally, as I've written in my books, since I think the first time I wrote about it was in 1997 in the international best-selling Financial Times published book, Trading Online, you do not want to be holding a stock when the monthly MACD is falling, okay? So we don't even miss the direction of the market because we have the monthly MACD in there incorporated. We haven't even missed the direction of the market, okay? Which is why we were in cash in 2022. Was it painful? Yes. Now, we didn't know we had to be in cash the whole year. In fact, we weren't in cash the whole year. What happened is in January, I said, I think I'll wait till the February list. In February, we said the March list. In March, I said the April list. April, I said the May list. So we look at all of these. They have to be all green. And we look at the price chart to make sure that the monthly MACD is rising. Okay, which both on the S&P, or rather, let's put it this way, not falling. There's a few other nuances. Not falling, because if it is falling, i.e. the overall direction of the market is down, like in 2022, then you do not want to be in. Okay, if it's a baby bear or mama bear, doesn't matter, you can ignore it. But if it's a daddy bear like 2022, then you do not want to be in. So you take all of those and you take the price charts, which I've been showing you for the last 56 minutes and showing you the overall direction of the stocks and the S&P. 12 months, 25% from peak. Most important numbers, again, what you want to be looking at. Okay, make sure you got value, growth, income, got all of these, and make sure you've looked at those, monitoring frequently, maybe once a fortnight, otherwise you get a heart attack. 12 months, 15 stocks, 20 stocks, 25 stocks. No point going more than, 25% drop, 15 to 40 stocks, 25% drop from peak. But like I said, that might change. Okay. And why 20? Well, once you get past 40, it's just an administrative burden. You're not removing market risk. The best way to move market risk is to be in cash, not to be in the market. And how would you know when to do that? When it's a daddy bear. Remember what I said. What's a daddy bear? It's when, let's take the S&P 500, the market. If the direction of the MACD is falling, then it's a daddy bear, falling below its own moving average, and you would be in cash and you want to remove market risk at that point. Okay, especially on email as well, joining Jeremy. Yeah, or you can ask him any questions as well. Nick, you can use TradingView is free. I use TradingView and TrendSpider, but TradingView is free, so you're more than welcome to use TradingView. It's free as well. Yeah. Okay. Book launches. They're some of the books in which I've discussed all of this. Anyway, when I was writing the weekly Financial Times column, and I'd go through my portfolio every single week from 2000 to 2004, no, 1999 to 2004, until I launched the fund. I had to each week write about not just what I'm doing, but why. So I took the academic research from three economists, Daniel Kahneman, Eugene Famer, and Richard Thaler, and I put it into the books. So there it is, the variety of books that are there. In fact, I am going to give you a free copy of one of the books right now. There you go. That should be there. Investing Unplugged, which is that one. Palgrave Macmillan published that. The Financial Times published that. The Financial Times published that as well. Wiley published this. That's Macmillan again. That's the Financial Times again. So I've had multiple. That was sponsored by Halifax Bank of Scotland. Anyway, and that's Financial Times again, who published that one. That was in collaboration with the London International Financial Futures Exchange, which is published by Harriman, which I think now is an imprint of Palgrave Macmillan, I believe, as well, which is these. Okay. This is the croaky one I wanted to show you from earlier, cash return on capital invested and why it's so important. This is the Goldman Sachs slide. When I launched the fund, Jim O'Neill, the chairman, and I had lunch with about 20 other people in a room. It was a buffet lunch, and they presented this. It comes from their research division, their quantum database. And what it shows is 30% per annum is what companies in the top quartile deliver, but which have got high cash return on capital invested. What is croaky? It is this. Capital that the business invested, let's say it bought plant, and this is the cash it produces by selling what that plant produces, all right? And it was 30% was what they do. Not every year, not every stock in the basket, because in the financial crisis, none of them did that. So it's not guaranteed. Those people who look for guarantees, oh, can you guarantee me a return? They should not be in the stock market. I'll tell you other people who shouldn't be in the stock market. People who think that any process will lead to all the stocks delivering the same returns. Okay, that's one. People who think that all the stocks will be delivering amazing returns. There's another group of people. People who think there'll never be a down year, i.e. that you can beat down years. No. If there's a headwind, you're unlikely to beat a down year. There tends to be a lot more tailwinds than headwinds, thankfully. But if we got 2022 again, my performance, if we kept getting 2022 from now for another 20 years, my performance will probably be close to 0% per annum. Okay, so if the stock market does what it did in 2022 every single year for the next 10 years, then for the next 10 years, my pension will not grow. All right, just so you know. Thankfully, the probability of it doing that is probably low, I think. You might disagree. If you do, you should not also be in the stock market. Simple as that. This is a typical portfolio of what people send me it's a bunch of companies which just don't hit enough of the markers, and then too many funds. Each one of these funds will have about 50 to 100 stocks in them, so their performance is going to basically stink. And you can see here over the previous 6 months from when they sent me this, it was pretty much a stinker anyway. And they've grown it over a period of time. They don't know when to get out. They don't know why they bought it. They don't know why they're still holding it. And as a result of which, all their money sunk in something where they can't put it into anything better. Here's another typical one. Bruin Dolphin, this person put their money in. Stocks spread over 1,000 different companies, scattergun effect. Really don't know who to trust. Fisher Investments approached me and want to put everything there into a single fund. Very scary. No kidding, Fisher want to do that because they're in the same basket. Okay. Stan, no. There won't be, guys, no. I don't know what the plans are for the future, but it won't be getting cheaper. I can tell you that. So whatever the installments are at the moment, it will never get cheaper, lower than that. Just so you know, for those who are thinking that there's something big discount coming, there isn't. The prices are going to keep going up, I'm afraid, because they go up in tandem with the market. So unless the market crashes tomorrow morning, the rate of inflation of the market, which was up 55% last year, is why the price went up 55% last year. Okay. And this year, the market's already up. What is it? 20% plus. So there's another price rise coming. Sorry. But if people are making shed loads of money, it's only right that they're charged. Don't ask me. That's what the Conservatives and, well, that's what the Labour Party says. If people are making lots of money, they should be charged accordingly. So that's it. That's the goal. That's the data, okay, that I want to give. These are some of the people who worked for me. My point being, you can train anybody, okay? Kirsty was a secretary, she's now a pension solicitor. Naomi worked for me for 2 years as my assistant, and she went on to run a fund. Straight after my firm, she went to Newton. Okay, 2 years. So straight out of university, works for me for 2 years. Then Newton. I'm not saying I am responsible for very intelligent women's success. I'm not that man. But what I'm saying is, you can teach people straight out of an English literature degree. Okay, Kirsty did the same. Her degree was not in finance. Now she's a pension lawyer. Susan is Wells Fargo global head of communications. And Kanira is in the venture capital industry. And again, worked for me for actually Kanira about 4 or 5 years. The point is, finance doesn't require a financial background. None of these had a financial background when they joined my firm. You don't need it. It's like I'm a driving instructor in teaching people to drive. You don't need to have driven a car before to be able to get ahead. Okay, they're phenomenally talented individuals, and they would have been hugely successful whether they met me or not. And that's the point. You don't need to have learned finance to have got ahead. Often asked this, how can we start? This is how everything came about. It was originally going to be 250 people. I was going to cap it at, but actually we're not having a problem. I might cap it at 300. And then after that, charge more on a monthly ongoing basis, the current installment rate, but forever. At the moment, the installments are capped. You only pay for 2 years. That's it. But it's yours for life. In future, it'd be forever. You'd have to. Okay. And we'll have to work out a way of how to deal with the conflict. But it's not a problem I need to deal with right now, because at the moment, I'm quite happy with how things are. This is something that I wanted to eventually, hopefully, float. And the reason for it is this. You've got St. James's Place, which was in the FTSE 100 with 900,000 clients who are miserable and delivering a poor service. If you can remove them by having a firm where the asset management aspect is actually handled by the clients, just like Uber doesn't own cars, Airbnb doesn't own apartments. How about an asset management company that doesn't have your assets? It has you managing your assets, but gives you the data and the know-how to be able to do it yourself. Isn't that phenomenal? And given the praise that the approach and the work that I've been doing over the last 20 odd years had got, I thought, you know what, we need to make this into a more focused thing. And when we launched it, these are all videos. We did videos. It's on alpeshpatel.com. It was great because we had to do videos because I thought people aren't going to believe the praise. So we did videos. And my aim is to make sure that we can get rid of companies like the wealth mismanagers, like the St. James's Place of the world, who basically will not be able to go into cash in a downturn, lose 6 years of your pension, deliver slightly over bank manager rates, bank rates, and spray and pray into a load of cross-country funds. Just ask them two questions. How did you do in 2022? Okay. And ask them, what's the Sortino ratio? You know, you will see the same old gumph coming out of those firms. And I say this, you might say, well, wait a minute, what's your qualifications? More than any of their fund managers in relevant subjects. Okay, so I can tell you that what they're trying to sell you, the narrative of, oh, well, they're well qualified to generate alpha. No, I'll tell you what's well qualified to generate alpha. Companies which have a history of generating alpha. Not me. I don't have an opinion on stocks. The computer has an opinion on stocks. I follow the opinion. What generates alpha? Market performing return. Not me. Companies which have a history of generating alpha. Duh. Not the fund manager. Why would he? Why would he stick himself in the middle? Why would I stick myself in the middle? I'll just cheat and look at the companies which statistically have generated alpha. It's really simple. Okay. So we put it all together and we thought, well, how can we shake the industry up? Because it's ripe for shaking up, and it would give us a company which we can float, which would be immensely satisfying in many, many, many ways, all the ways you can imagine. Okay. So what should we do? These are the two main things people wanted. Those were the two main things. And what I've kept it at the moment, I think until I get to about 300 people, is that I will do the mentoring. Early members getting a piece of the float would be a good idea. Keith, the funny thing is, I did used to say that, and that is the intention, subject to what lawyers say. It's exactly that, is to give free stocks away. Stan, yeah, you just go to, I'll send you a thing. That way you'll save a lot of money, because you're saving a lot of money because you're not having to, you're not having to, I'll send it afterwards. Dipak, do you get your money back if you make a loss? Yeah, only if you give me all your profits. If you make a gain, then I'm more than happy to do it in both ways. Okay, so give me all your profits and I'll cover your losses for you. No worries at all, forever. Okay, one-to-one. And those were the two main things that they wanted. Also, the maths, that's the ROI. So just look at the ROI. Okay, it's that one. And that's how we sort of worked it out. We just said to people, wait a minute, what's in your portfolio? And what if you get an uplift just in 1 year? You've got it for life, but what if you got it just even in 1 year? And you might say, well, hang on, you're getting credit for a market tailwind. Why? You're getting credit for Microsoft, say, going up. Why? That's not fair. Fine. I know. If there's a market tailwind, we do incredibly well. We don't find companies which don't exist in a market downturn, which go up when nothing's going up. We can't invent companies to invest in. So that's not what we can do. So yeah, if there's a tailwind, we do extremely well. And if there's a headwind, well, we hold cash. And you might say, well, no, you're holding cash. That's not good. My bank pays me for holding cash. Yeah, they'll keep paying you for holding cash in those down years anyway. But that's the way it is. Anyway, if you'd like to join on that, and that's what we did, it's not a stock picking service. I'm not picking stocks for you. I'm going to give you the data and filter the ones which meet our criteria. Okay. A stock picking service would be one saying, you're paying me a subscription. Shit, I better give you some names every single week, even if it's a crap week. So in years like 2022, I better just give you some names and it's your money. I couldn't care less if you win it or lose it. Plus, in those, you'll be speaking to journalists. Seriously, come on, they're freaking journalists. Okay. They're not fund managers. And the other thing is, you won't be speaking to them. They won't ever speak to you one-to-one and explain what's going on. You don't just want stock names. You want to know the data and why. I'll give you an example. Each month, when we do a monthly update to clients, imagine I'm McKinsey and I come along to you and I say to you, here's the further filtered list for 2024, Mr. Chairman. Stan, you're the chairman of your firm. Here's the further filtered list. And you turn around and you say, yeah, that's all well and good. You give me the summary of the ones you think are the ideal ones, but I want the data. So we said, well, here's the Excel spreadsheet where you can see the data. And you go, well, that's very well. I got all this bloody data. What the heck does it mean? I don't understand. You know, now, do you at that point want me to explain why you want undervalued growth companies with Croaky and give you the literature on the Nobel Prize winners and what the data is and why? Probably yes. Or do you want me to say, yeah, well, I woke up this morning and I just thought, you know what, I think this crypto thing could be quite big. So yeah, I think you should get into this. And yeah, the numbers look really good. No, because you need 10,000 companies to go through. Journalists can't do that. Okay, you think the journalists are doing this? Do you really think they're going through all of this and they're filtering it? Or do you think they're thinking, shit, I've got a word count for Motley Fool that I've got to hit, and I better hit it soon? And in the down market, do you think they're ever going to say to you, well, this year we won't have any additions for the next 52 weeks because we don't think there's anything safe and stable to invest in? Or do you think they're thinking, shit, we need more subscribers, give them anything, just speculate? It's up to you. All right. Jeremy, no, happily we'll do that. Well, it's all here. I'll show you where it is. Okay, if you're interested, it's on screen. You can literally see it on screen. Okay, so that is the installment plan on there as well. And I've also put a link there if you want to, if it's for you. For now, it's going to be a one-off payment. In future ones, I think we get past 300, I think I'll do. But I'll have to see. It might be 310 because it's fine at the moment. People learn to drive and then they don't need to message me and stuff. But it is me that would be for the first, let's call it 300, their mentor, and for life, unlimited access. People say, what happens if you drop under a bus? Well, actually, once you've learned to drive, the only thing you'd actually ever miss, the company would still give you data, okay, and all that, and you'd all have all the online education I've produced. So you'd still be seancing with me, as it were, through the online education. But my vice president, imagine the president gets assassinated, the vice president would take over, and he would tell you what I'm telling you in terms of how to read the data and that. So what we do is when we give you this data, do you see down there where it says June filtered, which I'm obviously not going to click because that would give you the ones which hit all of these first 5. We only select from there. And then what happens is we take all of that data and then we look at the charts for every single one of those stocks and then present, oh no, not that one, that's the stock market update, this one, from the monthly update, further filtered. And then we say to you, this is the final, say 50 for the next 12 months. If you've already joined a year earlier, or sorry, a month earlier, you don't need to watch that because you've already fully invested for the next 12 months. These are people who haven't. They keep, so we do it each month as an update for them. This is, I guess, the most important slide in many ways. That's what people want. This is what IFAs do, which isn't good. Okay, what IFAs do isn't good. All right. Some good more comments. Have a look at my campaign for $1 million. It's a campaign to teach 1 million people how to be better investors and make an extra $1 million into their pensions over their lifetimes through better investment knowledge. That's the goal of it. Thank you very much. Some of you have said, well, you've asked various questions. I'll answer them offline later. Some of you have asked for links. I'll make sure you get those links as well. So there's no issues there. So for all of those who have signed up, thank you very much. I will speak to you offline. I think I can see some names that have come through. So thank you. I've got Martin, I've got Terence, I've got Christopher. Thank you. I will speak to you offline very soon indeed. What else? Jeremy. Yep, I think you've got it. The link now. Let me know if you've got it as well. Yeah, the replay will be posted on various channels later, YouTube and all the rest of it at some stage. Okay, thank you all very much. Oh, split of ETFs to individual securities. Is there a risk mitigation strategy behind this? Yeah, Kishan, it depends on your risk appetite. So if you're older and you want less risk, you'll put more ETFs. It's on the individual. And so what we do is we show the individual what their risk appetite would be, and then they can pick how much money should be in cash, how much, say 10% say in cash. They might put 20% in lower volatility ETFs because that's why you generally be in ETFs, and then the rest in individual stocks. However, separate to that would be if they do double leverage anything, you'd put that into a separate strategy. But on the whole, the ETFs are because you want less volatility, and you can see the volatility numbers for ETFs. And when you see those, you say to yourself, oh, I see. So we give you the ETF data as well, because we've got some people who only invest in ETFs, which is fine as well. Okay. Thank you all very much. Anything else I've missed, let me know. Good. Thank you, Jeremy. I look forward to it. Well, thank you, Stan. Excuse me. I'll make sure you get the broadcast replay, all on Telegram and everything else. So thanks, everyone. Oh, let me see which one. This one. Thanks, everyone. I'm going to go for a bike ride in Richmond now. Well, not right now. Thanks, everyone. Thank you. And any other questions, let me know at some other time, and I will answer them. Okay. Whoops.